What up, fellas? Look, we've been on a little journey here. We've talked about where to enter. We've talked about some plays. Today, we're going to be talking about risk management. The number one rule of trading, the golden rule of trading, according to Warren Buffett, is number one, never lose money. Rule number two, never forget rule number one. So trading is not about never taking losses. It's just about taking unnecessary ones. The pros survive because they protect capital, they control risk, and they let the math work in their favor. And I think this is the biggest thing that people struggle with. People struggle with risk and position sizing. No one's ever position sized. I've been doing Dunki. We've been doing this a long time. Brian, you've been doing this a long time. You've seen people come and go, in and out of Discord, in and out of trading. And it usually almost always boils down to they're not risked properly and they're not position sized. And when you're not risked properly, Brian, and you're not position sized properly, you're doing what instead of trading?
You're gambling.
You're at the casino table. You're at that poker table, 100%. So Nick, talk just a little bit about how much of your account per trade. Like what's the professional standard?
1 to 2% account risk.
Yeah.
I think if you're good, it can get a little bigger than that. But
yeah, and that's like when I say professional standard, right? Like that's hedge funds, right?
Yeah.
That's big money. That's whales. That's professional trader shit. That's not gambler shit. That's I want to be wealthy. That's I want to have my money and make money over the next 5, 10, 15, 20 years. Not I want to go and buy a lottery ticket, right? This is how real professionals trade is 1 to 2% of your account. And I think for the sake of this video and for the sake of like new and intermediate traders, it's 1% per account. And Nick, do you want to explain why 1% per account? Do you know what I'm asking here?
I mean, because when things go bad, you need money to trade, right? So I'd rather take a crack at it 100 times in a row than take a crack at it 4 times and be liquidated completely in my account.
That's what I'm after. So if you are, and look, I can only I imagine that most traders are, and when I say most traders, right? Because we know most traders fail. I'm putting me into this group, like the old me. Like I was risking a lot on my account. I was risking 5, 10% per trade. If you're risking 10% per trade, Brian, let's see how good your math is. If you're risking 10% per trade, how many trades do you need to lose in order to go to zero?
10% per trade, 10.
Yeah, that's it. And your account's done. It's blown up. It's dead,
Yep.
right?
Out of capital.
And that was me.
That was me. Almost everybody, dude. It's like,
Yeah, it is. And to be 100% honest, it wasn't until I started risking and sizing properly that I got profitable. And I understand, Brian, I'm sure you understand too. Why do people, I think most people, if they've been in the trading, if they've watched some videos around risk and psychology, they know this, right? I think most people know 1%, 2% risk. I think they don't do it, but I think they've heard it. They understand the golden rule. They understand you're a risk manager first. Maybe not right away, but after you're like, okay, I'm going to start learning this. They usually hear that. Why do you think? What's the psychology behind like just not doing that?
I was actually listening to I was listening to an audiobook yesterday, the Power of Habit or something like that. And it talked about this. It talked about how gamblers, they get their dopamine rush right before they take the risk. And that's their reward is the gamble. I think that the psychology behind risking too much is impatience. Everybody's impatient. And I think that a lot of people talk about risk, but they don't really accept risk. Like an acceptable risk is like 1 to 2%. They might slide it up and risk 10% of their account, 15% of their account and lose. And they may have thought that, you know what, I'm going to take this risk. But when it comes time to accept that risk, they go haywire. And then their mind is off, their emotions are set, and then they're out of that trading mindset. Now they're in just a straight up gambling mindset. I have to recover this. I'm going to up the leverage. I'm going to up the risk. I'm going to up everything. And then you're just you're just blindfolded and throwing darts everywhere. So one thing that I have seen through working with a lot of traders is that they want to move too fast. They're just too impatient. Like they want to, like a $50,000 account. It's not enough to have $100,000 next year. They need to have $1 million in 6 months. And so, they really don't see it as a long game. And so when you're not playing the long game, the game ends faster.
Yeah. And I love what you said. As a matter of fact, I just wrote it down in Discord. You said, for some people, the gamble is the reward. I think that's
The dopamine
key.
hit.
I
Yeah.
think that's a quote, dude. Yeah, I agree with you. I think for some people, the gamble is the reward. I think for some people, that's how they get their dopamine fix. They don't even want to be traders, right? They just want dopamine, man. That's all they want. Who said you get what you want out of the markets? I don't remember who said that, but I feel like some famous trader said that. I got so many trading quotes floating around in my head now. I don't even remember who they're attributed to anymore. I'm going to say I said it. I came up with that one. You get what you want out of the markets. And for some people, I think it's the gamble. I think it really is the gamble. And I understand it from a psychological standpoint. I understand wanting to change your life and wanting it fast. I get it. I understand wanting to have that $1 million. I understand it. I get it. I understand it. But that wanting, that yearning,
The
can
tower
also
you
be-
got to build.
yeah, that can be the death of you. And it look, I got into not trading, but I got into crypto on the promises of riches, right? Like that's why I got into it, because I thought it was going to be boom. I have $100 million, right? Overnight. Like that's how my brain worked.
Safe moon, baby.
Yeah.
It's a safe
And
investment.
but I quickly realized, it didn't take me long to realize that is not the case. So I understand it, but you need to get over that shit quickly. And if you don't, then you're just here for dopamine. If you don't get over that shit quickly, you're just here for dopamine. And there are some people out there who I think are okay with it being gambling. I think they're fine with it. I think they know what they're doing. Not know what they're doing as in they're going to make a bunch of money, but they're throwing money at shit and they're gambling and they're okay with that. Great. Good for you. That's not why I'm here. So back to
Okay,
the
here's the
1%.
quote, though, if you want it. Win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money. And that was Ed Sakota.
Sakota. Yeah. Yep.
It's
Say that
kind of
quote
like
again, dude.
Say it again.
Yeah.
Win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money.
it's like the James Wynn story, right? He went up, he risked everything, and then he would do posts about, I wouldn't change a thing. Some guys risk it all. Some guys never risk anything. And then it's like, it's some serious cope.
It's losing mindset.
Yeah, it's serious cope. It's such a sad story to see someone just gamble everything. And I think that,
On a public
it's like
scale too.
it's like people who smoke, right? They always know one smoker who lived to be 105, right? It's like, my uncle lived to be 105, so I'm taking the risk. They don't consider the billions of people that die.
Yeah.
But they're focusing
They're
on
the
that
exception
one
to the rule.
Yeah, and it's the same thing with investing or crypto. It's like my cousin's sister bought Amazon and got rich, and so they're always thinking about that one, just
So I'm top blasting it.
1 in a million shot, and they're not considering the 90% of people that are getting washed every single 6 months.
Yeah, and we have
Yeah.
talked about the statistics of, I think in the last video, or I don't even remember, dude. We
Yeah,
talked
starting to
about
remember.
like how, oh no, it was the crypto, the intro to crypto bootcamp thing I just did. Free intro to crypto bootcamp on our website, by the way. Like 75% of professional athletes go broke within 3 years.
Yep.
Right. It's something insane.
Retirement.
like after 3 years retirement. Yeah. I forget the exact statistics, but it's something like 75% of lottery winners go broke in the first 5 years.
Yep.
And then like every year after that, that just rises and rises and rises, right? So statistically, even if a person gets lucky in whatever, they hit a scratch off ticket, they hit the lottery, right? Statistically, you're going to lose that money. Because what happens? Like what's the you give someone a bunch of money who has no experience, who has no solid foundation in finance, who couldn't balance a checkbook before, you're just amplifying that, right? That's all you're doing, is you're amplifying that.
Yeah. Giving
Remember
somebody
when
money
I
doesn't
asked you
give
the
them
question?
principles of money.
Yeah, you remember when I asked you the question, Nick? I said like, I don't remember how I phrased it. It was like, do you think money makes you
An asshole or
yeah,
something like that.
and I think your response was, I think it just amplifies who you are.
Yeah.
Right. So if you're bad with money, like, and let's face it, I was bad with money. I grew up with nothing, right? I grew up with nothing. I was bad with money throughout my 20s, dude. I fucking ruined my credit, right? I fucking everything done. Had no credit. Bill collectors calling, right? I had no idea what I was doing. I mean, it's the same thing. It's just you're amplifying that with money. So it's the James Wynn story, right? Gets lucky on some shit coins and then blows it all up thinking he's a trader. It's the same thing. So 1% of your account per trade, professional standard. And I want to talk about position sizing too. And then I want to give the audience some examples, and I want to give them an easy formula to figure this out. So we had a little bit of this conversation today in Discord around the trade that some people took today. A lot of people caught the same short I did today. I was the only one who survived it. Okay. And I think there was a lesson there. And that lesson is in risk and position sizing. So I think, and this is me included in this, I used to slide my slider up to 100% on every single trade. Every single trade, I was full porting 100% of my portfolio, right? Of my trading thing. And when you do that, when you slide your slider up to 100%, Nick, and we're talking about stop losses, if I'm using 20 times, 30 times, 40 times, 50 times leverage, how quickly does my stop loss get hit if I'm full porting an account?
Very fast.
Very fast. Very, very,
Margin for
very
error
fast.
gets very slim.
Yep. And now let's scale that back a little bit. What if I am using 50% of my account, 10 times leverage? Can I position size properly for a bounce or an SFP or something like that? Just generally speaking.
Yeah.
Yeah. 100%. And risk 1% of my account, have my stop loss in an invalidation point and my target, right? So that's what this is about. So we're going to talk risk dollars, account size, and stop distance. And what we're not going to be talking about is the asset. We're not going to be talking about leverage or margin. And we're not going to be talking about stocks or crypto, because this works across any asset, any margin, any leverage. It has nothing to do with leverage. Everything to do with just risk dollars and account size. So let's talk about it here. So I'm going to quickly share my screen just to show the formula so everyone can understand and follow along. Boom. All right. So look, the 1% rule of risk. You risk 1% of your account per trade. That's the professional standard. So there's a formula for this. Your risk dollars is your account size times 0.01. It's just 1% of your account. That does not mean if you have a $50,000 account, you're only trading with $500. Now, there was once upon a time when I first was trying to figure this out, that's what I thought. That's why I'm saying that. So when like a long time ago, when I was first trying this out, when people said, don't risk more than 1% of your account, I thought they meant $500. Does that make sense?
Yeah.
How I'm explaining that? But that's not what it is. You just can't lose more than $500 on a trade. You can use as much of your account as you want, but you cannot lose more than $500 on a single trade in this example with a $50,000 account, right? If it's a $10,000 account, it's $100, right? If it's $100, it's $1. That's what it is. So you figure out your account size, which should be pretty freaking easy. How much money is in your account? You times it by 1% or 0.01. That gives you your risk dollars. So in the case of this example, that's 500. Am I explaining this clear? Everyone with me?
Mhm.
Okay. Then for your position size, you take your risk dollars, which is 500. That's 1% of your account. And you divide it by the stop distance dollars. So this is where people get tripped up. What is stop distance dollars?
It's the
Well,
amount
first of all, let me
pips.
ask Brian, where does your stop loss go?
Your stop loss goes where you're wrong. You're in
Yep.
validation. That's
And
it.
that's the only acceptable answer. Nothing else matters here. The only acceptable answer is the one Brian just gave, which is your stop loss goes where you are wrong, where your trade is invalidated. Just quick examples, if you're in an SFP, if you're trading a liquidity grab, above the wick, right? If you're trading support and resistance or range acceptance, it goes above or below it, right? Well, we'll get into specifics later, but just very generic examples. So if your stop loss is $300 away, then you would take your risk dollars, which is 500, and divide it by 300. And then that will spit out a number. So, and this is like a Bitcoin example. I know like if you're trading Tesla stock, right, you're not going to have a $300 stop loss. You're going to have a $3 stop loss, right? But for Bitcoin, 500 divided by 300 is 1.6. So your position size, regardless of leverage, is 1.6. So you log on to your exchange or your broker, you slide your slider up to 1.6 Bitcoin, you hit long or short, and then you put your stop loss where you have planned it out, where you're invalidated, and you're done. You are now only risking 1% of your account on the trade. If you're wrong, you have clear invalidation, because where you're wrong, you're wrong. Let the market tell you you're wrong. Take your lick. Go back to the drawing board. Figure out why you were wrong. But this will give you the proper position sizing. Now, let's just take, that's a Bitcoin example, right, with 1.6. Now, I'm going to quickly share a different screen. Let's just do one real quick on Tesla. Let's just do Tesla stock. I mean, we can do any of these things, but
Is that the weekly just dumping or the daily?
I'm still on Bitcoin. So Tesla right here, right? So again, let's just pretend that you want to go long here. Just pretend, right? Off this blue line here. You take your long and short tool. They are, I think, 5 down. Yes, right here on the left. Long and short positions, star them. You're going to live by these. So we're going to go long right here. My stop loss is going to be where it's invalidated. Now, for me, I'm going to put my stop below this diagonal, right? Price comes down. Maybe it sweeps it a little bit, bounces at the diagonal and reclaims it. My stop's going to be outside of that. So that's $10, right? That's a $10 stop on Tesla. So if I have a $50,000 account, I'm going to do, that's 500. Oops. Right. 1% of my account's $500 divided by, $10, right? So that's 50 shares of Tesla. That's my position size. That's it. Quick, easy math. I'm now risking only 1% of my account. My stop loss is in a clear place for invalidation where I'm wrong. If we lose this trend line, I'm wrong. My thesis is wrong. And then 50 shares of Tesla is my position size. That's it. That's
You
the
can show them how
formula.
you set that in the settings of the tool too.
I don't know that I change anything in here.
So you can, just for example's sake, lot size is the dollar pip, moving up and down of 1 unit. But under account size, you can put your if you put $50,000, you move the risk factor to 1%. It'll tell you exactly what you need to know, or your leverage. I don't know why your leverage is 10,000%, but all that stuff can be set to apply your rule set to the tool. And then you can just go to the template area down there and then save as and just call it your template.
Yeah. So right there, risk 1%. It's got my entry price, lot size, which I know now is 50, right?
Yep.
And boom, there's my play. And look, this will kind of segue us here in a little bit into another topic, which is going to be risk to reward, but this is a good trade. I mean, this isn't, I didn't even pick a target, but let's just say it's there. Maybe the start of that gap, right? 3.95. So it tells you your risk to reward.
Yep.
Remember, as like new traders, I firmly believe we should be aiming for 3 to 1.
Yeah, I don't want to take it for granted what that actually means. That means for every dollar risked, you make $3.95 on top of it. So if it's your stop loss is, I don't remember what it was,
So it
$350 bucks.
$10.
No, I meant like your actual risk.
Oh, $500.
So if he loses $500, if the play completes to the upside, he wins $1,500. It's 3 to 1.
Yep.
Almost 4 to 1. So almost $2,000.
Yep. A good trade in this case, properly planned, properly position sized, properly risk managed, stop in an area of invalidation, 1% on account. Good trade.
Yep.
If this goes, I make $2,000, right? If it loses, I lose $500.
4% on the accounts, the math. It's all math.
Yep.
This is the shit I actually like really love about it all. And the other thing too is, what would you say, Ben, is your ideal minimum risk?
Ideal minimum risk?
Yeah. What would be your risk to reward factor you would only take at a minimum?
3 to 1.
3 to 1. So if you're looking at a play and you draw it out and it's below a 3 to 1, what does that automatically do for you?
Invalidates it.
I don't want
to take the trade. No. Yep. 100%. 3 to 1. So this is a Tesla example, right? We did a Bitcoin example before. I suppose I'll real quickly, I will show. So this is Tesla. This is how I do it on stocks. Let's just do Bitcoin real quick. Let's do it from a short, right? So let's say this is last week's high right here. I have marked out. We want to go. What's that?
Show them the one you did today.
Yeah.
Real-time example.
So here we go. This was today. I mean, remember, all this stuff was already on my chart beforehand. I was looking at London high, this trend line, last week's high, last week's low. So you can plan this. Here's the beauty of this is you can plan this stuff out beforehand. You don't need to do all the math when you're about to hit execute. Yep. Because if you don't have a
shouldn't
right. If you don't have a plan before you enter, then you don't have an entry. You're gambling, right? Mm-hmm. So for me, I have a plan before I enter. That's why I'm at the computer an hour before market opens, so I can set all this up. But I want to go short off of one of these trend lines, right? So let's say it's the diagonal, which was the play today. I mean, we swept London high and we went to the diagonal. So where am I invalidated? Give yourself a little wiggle room. Like, it's going to depend on the asset. Like we just saw, it was $10 with Tesla, right? That was a nice invalidation. With Bitcoin, I usually like to go $200 or $300 away. Sometimes 400, depending on the market. So I'm going to put it $300 away. Boom. This is just me. That's not financial advice. You do you, but it should go where it's invalidated. But it should not go $5 above an SFP wick. Give yourself a little bit of room. Be a little bit reasonable. And then where's my target? Well, it was opposite side liquidity, which is London. And then obviously it went for way more, but this is it. So $50,000 account, right? So $500 is 1%. Easy math. My stop distance for invalidation is $305 away right here on the tool. So I will take again, it's going to be 1.6 Bitcoin divided by 300. Yeah, 1.66 Bitcoin. So I'm going to slide my slider up on the top right of your exchange. 1.6 still, it says 1.6 Bitcoin. I'm going to hit short, and then I'm going to put my stop exactly where I have it planned out right there at 92,551. I'm going to enter when it gets to my entry point, and I'm going to let the thing play out. That's it. Easy peasy. If you make it easy, right? Trading is easy. No, sorry. Trading is simple. It is not easy. Because the not easy part is everyone thinking they know better than the markets, right? Everyone thinks they know something. They have some, what's the thing that we like to tease? They figured it out. They cracked the code, right?
Yeah. I think that a huge part about risk is really planning out the trade, right? Seeing the move before it's there. And that's really where you get into that next level where it gets fun. When you can see the move before it's there, you can even anticipate what the move is going to be, right? You can say to yourself, hey, I've got a trend line here, but I've also got a session high. So if I'm going to take that liquidity, I'm going to be expecting an SFP. I have this other confluence here. So historically, I'm looking for this, and then I'm going to get the wick. And then it's like you can almost do it everything. I mean, I learned that watching you guys trade is that everything's done, right? It's just, you're just waiting for it to happen, and then you can hop on it. But anything can happen, right? Anything's possible, but we trade what's probable.
Yep.
Yeah, I call it theory crafting. So
Yeah. And so
you hear me say that a lot.
having the plan before you engage in the mission is absolutely key. Me, I used to see a wick and I'd say, okay, it's an SFP. There was no target. So I didn't know where I was trading to. I just know that, something just happened and I see it moving in another direction. I have to short or I have to long. And I look back on my old notes, and I mean, I found an old journal, and I was just thinking, oh my God, this is just insane. Like,
But why is that
insane.
important that you found an old journal? Because what did you just do? You realize how far you've come.
Well,
You've walked the path.
even back when I didn't know a damn thing, I kept a journal. Granted, it was a lot different. It was, it was just mostly emotions and feelings and frustrations and stuff. But yeah, now it's just like I can map out a trade. If that trade comes and it doesn't look good or the risk to reward isn't good, I just don't take the trade. And I think that's a huge part about risk. Also, is a massive part about risk is you have to be okay with just not taking your trade. I think that a lot of people will make a plan, and then they'll see an SFP or a little bit. Like, you just have to be okay to say, you know what, I'm going to sit this one out. I'll catch the next one.
And you don't give a shit, right? Like, you don't care. And that's how I am. Like, I do not care. Like, not even a little bit, man. I used to. I used to care, right? I used to get pissed off if I missed a move or something. Now I don't give a shit, dude.
Yeah.
And that's I think where people mess up too. And it goes back to what you said at the beginning is everyone wants to be rich super, super fast. So if they miss a move, if they mess up, they go on tilt, right?
Yeah.
And that's just, you're going to learn one way or the other that's wrong. You're going to learn. You're going to learn that most moves you shouldn't be in, most moves you won't be in, right? But that was me. I mean, I remember the days where I would get pissed off missing a move. Now I just don't care, man.
Tomorrow's another day, brother. It'll be another trade. And I think even with that is you said it earlier, is like, just if the play goes wrong, reassess. Like, emphasize you need to stop and reassess, because if you just start jumping in and chasing things because you second guess everything you just did, it's when accounts go down very, very fast.
Mm-hmm. Mm-hmm. And why? Why it matters, right? It keeps drawdowns survivable. It keeps your emotions out of execution. It keeps you compounding long enough to win the game. Professionals focus on longevity. They do not focus on adrenaline. They do not focus on dopamine. We don't care if we miss moves. There's always a move tomorrow. There's a move every day. The markets are never just $1 forever, right? There's always ups and downs and ebbs and flows. When you do this long enough, you realize that.
It's a good feeling too when you're in some drawdown and you can just say, you know what, it's acceptable risk. And I've got a target, I've got an invalidation, and they're set. And I'm going to go off and do something else. You can't stare at it and think that it's going to help. Right?
Mm-hmm.
It's
You're willing it to go the way you want.
Yeah,
it to go.
you know what I mean. You can't.
You're willing to me, Riggs.
Yeah, it's not. It doesn't work. You staring at it is only going to make you sicker.
Right.
If it's there, then everything's there. You have an invalidation. You have a target. You have acceptable risk.
Get up and walk away, man.
Walk away and let it do its thing. And I love that feeling where I come back and I'm still in the trade and it's actually doing what I think it should be doing. Or I come back and I got stopped out, and then that's it. Reassess and let it develop. I think that is another thing about risk is that if you get it invalidated and your trade is stopped out, you can have a backup plan. But a lot of times what you need to do is what I needed to do was to let it develop. Price develops, right? It's either
Oh.
gathering liquidity, gathering all the suckers, or it's accessing liquidity, right? It's either going somewhere, seeking balance, or it's balancing. When I realized that, I got real patient. Like I didn't have to get in every micro move on the 1 minute chart. That's like when I see guys in there and they're like, oh, 1 minute, on the 1 minute, it's like, dude, zoom out. You're way too zoomed in. On the 1 minute, everything is a massive move.
Yeah.
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 All right. So we kind of we talked about this briefly. Brian, you said it, right? Stops go where your trade is invalidated. They don't go where it feels safe, right? They don't go in some arbitrary spot. It simply goes where your trade is invalidated. So if you're going long, where would, like, just generally speaking, if you're going long, where are some generic spots to put a stop loss?
If you're going long,
Yeah, just generically.
it depends, right? So if I'm trading a trend, right? If I'm trading an upwards trend, I might move my stop 2 lows back. If I'm trading a range, right, I might set my stop a little bit below where I think the general public is hugging. I'm going to give myself some breathing room, right? Above the range, below the range. Typically, if I'm trading a range, I'm longing the bottom and shorting the top, and I'm taking profit along the point of control, value or high. So I don't mind putting my stop below the low of the range. But on a trend day, usually 2 stops, 2 lows back, or 2 highs back if I'm shorting. And if I'm in a range, below the range, a nice, comfortable thing below the range. One thing that I won't do is I won't ever, ever, ever again set my stop on what I'm willing to lose. I see a lot of people do that. They go, I'm willing to risk $200 on this, so I'll just slide my stop $200. The market be happy to take your $200. It's not what you're willing to lose. It has to be where you're wrong.
Yeah. So I think you said it. I'm just going to summarize it. So I think generically and very generally speaking, right? If you're going long, it's below some prior swing low, liquidity sweep, below the wicks, if it's short, above some prior swing high or some liquidity sweep. How about if it's a break and a retest and you're going to play the bounce, right? So let's just say, for example, we take out the value area high, come back and retest it, and then we're off to the races. Where does your stop go?
Well, the way that I trade, I'm always looking for where the trap was set, right? And where's price trying to go, and what are we moving away from? So I'm looking at order flow a lot of the times. So I'm saying if there's a retest and then we took off, well, the market has finished the business below that retest. It shouldn't go back there, right? If it does, the retest has failed. And that's where I would be wrong, right? I'd say that if we came up and we hit resistance, break, retest, and then continue and market structure change to the upside, then the market has no business going back under that retest. That's finished business. So every trade is different, trade specific.
Yeah, just generally speaking.
Underneath that retest, like where the finished business is, where the trap is set, I would be underneath the retest.
Yes.
Generally.
So I am sharing my screen. So here's what Brian was saying. So this is just a generic example. Any asset, it doesn't matter. Your thesis or your theory is breakout, retest, pump, right? What Brian is saying, like, if this is a breakout and retest, the business is finished down here, right? We're done. That's a breakout and a retest. Price gets accepted above and it runs up. So where is Brian? Yeah. So where is Brian wrong on his trade? Well, if that doesn't hold, he's wrong, and it's going to depend on the asset. You know what I mean? Like, Brian, you wouldn't put it like $1 underneath that reset, or that retest, right?
No, I always like to give myself a little bit of
A
a
little,
buffer.
yeah.
And the reason why is because most people will just go right to that line. And
Yeah.
I've been trading assets long enough to know that sometimes if the market needs a little bit, like I look at the market differently now, right? It's always looking for fuel. So sometimes it might just crawl back and just take those people who have their stops hugged right at that line and then continue off. And everybody's had
that's
that
pretty common.
experience. Yeah.
That's why I try to wait for, like, if I'm sitting there actively managing it in like a New York Open or an Asia Open, like I will wait for the candle body to close before I close the trade.
Yeah.
And if it wicks in there and just bounces and I didn't close the trade, it did exactly why, it proved to me why I have that method.
Yep. So how about, and I think Brian, you answered this too. I'm going to reshare my screen. So you were talking about range plays, right? So let's say, for example, this is the range, the, support, resistance, whatever, Amazon stock, SPY, QQQ, it doesn't matter. Gold is ranging, right? And if you're going to play the range and you're going to go long here, where are you wrong?
Below
if it
that.
loses the range.
Closes,
Yeah.
Right.
And typically
Right,
ranges aren't perfect, right? There'll be
Right.
little deviations from the range. And that's the beautiful thing about range trading is that,
Yep.
You'll get a little wick down below. And I love that because that shows me where the trap was set, where the market accessed liquidity. And when I'm thinking about liquidity and finished business, I want to see that wick. When it comes down there, it goes a little bit lower and takes off. That's a very, very, very comfortable place to put a stop loss because it took all those other stops.
Mm-hmm.
Right.
So like here's what Brian's talking about, right? Like, yeah, I drew a perfect range, but sometimes you get wicks, you get little deviations from the range. If you're going to go long here, where would the invalidation be? You saying like there, you know what I mean? Like below that low, below that wick, for example, right, Brian? I'm not putting words in your mouth, right? That's
no,
what
yeah, exactly. Yeah.
Okay. Yep. So yeah, 100%. So that's for range plays. So now here's the other one, right? So the other one is, and let me delete my scribbles here quick. So the other one is what about diagonals, right? What about diagonal breaks? So let's delete that. Let's delete that. And let's just draw a diagonal line right there. So, and these aren't ever perfect either. A lot of times they are. I think they're probably diagonals. I don't know. Do you think diagonals are usually more perfect than they're not? I guess it depends on how you draw them, right? But sometimes they're not. So let's talk about this. So let's say price is, whatever, little deviation, boom, little deviation, boom. And your theory is we're going to lose this. Your theory is I'm going to short this all the way down to a full liquidity sweep here. So you enter, and we can get super technical, and we'll talk about entries and stuff in the next. We don't need to do that today. So let's just be very general here. We'll talk about entries and stuff in the next one. But if your thesis is we're losing this, so I'm going to short it down, and you see it break, where's your invalidation?
Of the high.
Well,
above the breakage. Well, it could be just breaking back above that curve. It could be.
Yeah, I would say it depends. So sometimes, I would say it's situational. So I would say, yeah, you're right. But I would also say, is it invalidated if we go back above that high? Yes. Is it also invalidated if we break down and get accepted back above the trend line?
Yes. Could be.
Yes. So I think it depends on how far away that high is and what the risk reward looks like, right?
Yeah. So you could take the play two different ways. You could invalidate it back above that line, or you could invalidate it back above the high.
Yep. Sometimes though, if you go above the high, the risk reward
not worth it,
depending on the time frame. Like, for example, if you're on a 4-hour and that high is 10% away, you know what I mean? The risk reward might not work out depending on the asset and stuff. So an invalidation here could be two ways. It could be just acceptance back above the trend, give yourself a little wiggle room, or the high, depending on the risk to reward, I would think. Brian, any thoughts?
With trend trading, what helped me was to think about it as a flat line, because the behavior doesn't change. If we lose the line, it should backtest. If it does backtest, right, and then I get confirmation of the loss of trend, then that's easy, and that forces me to be a little bit more patient. So if a loss of trend, I'm looking for that backtest. If I get the backtest, which is the continuation of the market structure, then I have my invalidation, and it's proven invalidation, right? So
Yeah.
I like to think about all lines as flat, and the behavior doesn't change. I have a specific trade or rule on it with the trend line is third touch trade, fourth touch fade. When everyone can see and is trading an obvious trend line, I'm looking to fade that fourth touch. And
Yep.
typically what will happen is you'll lose that trend line. Everybody's panicking, right? You'll get that flush, but then you get that back test. And then for me, that's the confirmation. So that's where my invalidation would go. And then I can properly do my risk. And I'm even at this point, even okay with missing a trend line break because it could just be a fake out.
Yeah. But also, what usually happens before a trend line break?
What usually happens?
A liquidity grab, right? Like,
yeah.
I mean,
Yeah.
usually, not always. Okay, so how about some rules? And I think, Brian, you kind of mentioned this thing. Dunki, you did too. Never hide your stop inside noise. What's noise?
Any area between the top and bottom of the range you play.
Yeah. Or it might be like Brian was saying, or like kind of I said too, like, don't put it $1 below the line, right? Like, come on, like give yourself a little room, even on SFPs, right? Place it beyond whatever it is, the structure. We'll just say very generally speaking, right? And that structure could be an SFP wick. That structure could be a diagonal, whatever. Place it beyond that. And I'm not talking $1 for some assets might be good, but for Bitcoin, it's not, right? Because it's $100 and something thousand or $90,000 now. Always adjust the position size, not your stop distance. Never adjust your stop distance because your stop distance goes where you're wrong, where it's invalidated. So you do not move that. Just adjust the position size. How about this question? Nick, I'm sure you've heard this one before. Do you ever move your stop back? So if the trade's going against you, do you ever move your stop back?
Not unless this is a very situational thing, but general is no. If I've sized in like a 0.5% of a play and I'm looking for potentially for it to come higher to scale in the rest of the 1%, maybe. But generally speaking, rule of thumb, no. Once it's invalidated, I'm done. I'm just looking for the next play.
Yeah. And I think that's probably the right answer for most people. And I understand what you're saying about situationally, but you don't get to call audibles until you can follow the playbook.
Correct.
Right? Until you can follow the playbook, until you are a profitable trader, you do not get to deviate. You don't. You don't get to call audibles. You're not Peyton Manning. You're not Tom Brady. You're a freaking pee-wee football team, right? You don't get to call audibles. So yes, and we get asked that question a lot. Don't dig your hole deeper because that's what you're doing in most cases. And this is coming from experience, right, guys? I mean, we're not opining from a soapbox. We've done this shit.
We've lost
every day.
We've lost for you.
Yeah.
We've done the losing for you. Right? We've nuked accounts for you. You don't have to. Your money is your soldiers, and you're not going to throw more soldiers into a killing field. That's what you're doing when you're pushing your stop loss back.
Yeah, your stop loss, that's your line in the sand. Beyond it, your idea is wrong. That's it. And be wrong. Be wrong and only lose 1%. And be thankful that the market taught you a cheap lesson and learn from that lesson.
Yeah, I think that's a huge part. And I was talking to somebody yesterday. Yep. And now I'm talking directly to you, person I was talking to yesterday. If you are not having proper risk, then you're running away from your mistakes. And when you're wrong, it is mental capital when you can learn from it. When you fail forward, you're constantly getting better and better and better. If you fail and you lose everything, you're not even willing to look at what went wrong or where you went wrong, right? I think that so many people get into these just these depressive states when you lose. And
Woe is me.
improper risk can really mess you up psychologically. I've ruined furniture, told people I hate them, went and just like I've gotten fights with the girl. People know, oh, stay away from him. He must have had a bad day trading. I've been hidden in bathrooms, looking at everything going. I mean, you name it, I have experienced it. Like no stop loss, $19,000 into the hole, praying, and then just it's risk is everything. It is the most underrated skill in this game.
And it's the number one skill you need.
How much, this is a rhetorical question. How much more money do you think you would have today if from day one you followed this? A lot more, right? You wouldn't have lost that $19,000, Brian, right?
Oh, absolutely.
Yeah. So, but just think about the compounding since with that much more money is what I'm saying. You'd have more money, right? Considerably more money if I didn't blow up accounts at the beginning, I'd be considerably farther ahead than I am now.
But I needed to lose that.
Yeah.
Because I needed to lose that. The market needed to teach me a lesson. And I did let it teach me a lesson. It was a while before I was willing to take a look at it. But yeah, I needed to lose that. I think you need to learn those hard lessons that the market can only teach you through pain. I learn at the rate of pain, right? Smooth seas never made a good sailor. If the market that's why so many people lose in crypto, is because they were trading back when it was only going up. You could buy a coin, super high leverage, and not even have a stop loss. How many traders have we personally had relationships with that didn't even never use a stop loss?
Yeah.
That were trading large amounts of money. It's insane. And now it's not like that anymore, right? Welcome to the new reality, baby.
Mm-hmm.
There's 60,000 coins. Everybody's praying for this alt season that ain't coming. Nope. You got to learn how to trade now.
Yeah.
You got to learn how to trade now. And so you have to learn proper risk. What's a stop loss? Yeah.
Yep.
I needed to lose that 19,000, and I'm happy I did. And I'm happy I did it like 5,000, 10,000. I've lost a lot, but I've also won a lot. And now I know where my lane is.
Yeah. No, that makes sense.
It's trial by fire. We're trying to prevent the fire you have to walk across of.
Yeah, you don't look. I mean, let's be real. Most people are going to listen to us and to go in one ear and out the other ear. But there's going to be some people who listen to this and be like, you know what? They're probably right. And you don't have to lose $19,000. You don't, right? I've lost a shitload of money. I didn't have to do that. Like I didn't have to. I understand what you're saying from a psychological standpoint, but there are ways that you can trade to where you're not blowing up accounts, to where you're not
for sure.
risking and taking dumb risk. I mean, that's why mentors exist, right? That's why mentors exist. So you can live through the pain that they have learned, right?
I think that knowledge is learning from your own mistakes. Wisdom is being willing to learn from someone else's mistakes.
Yeah.
I think that anybody who's made it this far into this video, you want it, because most people have already tuned out, right? They're doing 10 different things, but if you're watching this
scrolling
video
TikTok
at this point,
right now,
right? You want it. And if you want it, you're listening. And if you're listening, then you don't have to go through all that, insert proper risk management now. Do it now. It should be the number one thing. Because like you told me in the beginning, Ben, you said, Brian, the goal is to stay in the game, right? And I always remember that. It's like poker, right? You don't go all in every hand. You're off the table when you lose that, right? The goal is to stay in the game and win hands and leave with the pot. it's all a big casino, and you ain't walking up into this casino, this $1 trillion casino, and you're just gonna beat the house. It's not gonna happen.
Where trading houses literally put their servers in the same building that the servers of the exchanges and brokers go in. You know what I mean?
For
We're
latency
talking,
purposes.
they are min-maxing milliseconds
Yeah.
of bandwidth, right? You're not going to walk in this casino and win. So you're
Do
right.
do you know the statistics on how much a casino wants out of every dollar?
Isn't it 1%?
Yeah, or it's like it's something small.
Yeah,
They
it's super
shoot
small.
for a super small percent of every dollar, and they're playing the long game.
Yeah.
Yeah.
And
That's how
their
they keep you happy.
odds,
They
a lot of
slowly
people
take
think
your
like
money.
casinos' odds are crazy better, right? But it's like 51% to 49%. I think Baccarat's 50-50. I think Baccarat, you had the best odds of winning at Baccarat, and it's 50-50.
Yeah.
So it's not like,
Well, if they fleece you in the first visit, you'd never come back.
yeah, exactly. Cool. All right. So we've talked about where stops go. We talked about risk management. We're going to be talking briefly about entries here. We're going to talk more about entries, and we've been talking about entries in all these videos. But so if stop losses go, so Brian, where do stop losses go?
They go where you're wrong.
So where do entries go?
Entries go where there's confirmation of your plan.
Yeah, where the market confirms your idea.
Yeah.
Yep. So if stop losses go where the market invalidates your idea, entries go where the market confirms your idea, not where you hope you're right. So this, I think, so I am training somebody, and I'm having trouble getting through to him on this, right? He wants me to keep spending more time on entries. And I'm like, brother, you have to have an idea. Like you have to show up to the market before it opens. You have to get your ass out of bed, right? Show up to the fucking market, make a plan, and then have the market confirm your plan. That's it. That's where your entry goes. Well, which trend line is it? Whichever one the market confirms your idea off of. That's it, right? So what do I mean by that? Well, I'm going to show you real quick. And there's lots of different ways to make an egg, right? Some people like scrambled, some people like hard boiled. However you get to your freaking levels, right? Let the market confirm them. So here's what that looks like for me. I don't care if we go up or down. I mean, for my, when I'm holding Bitcoin, I care. When I'm not holding, I don't care. But I have to separate the day trader Ben from I have an IRA, an investment account Ben, and I have Bitcoin Ben. I have to separate day trader Ben from that person. They are two different people. Day trader Ben doesn't give a fuck if Bitcoin goes up or down. All I care about is where are the eyes looking, right? And we talked about that in the first video in this series. A few videos back, we talked about what levels, right? Weekly highs, weekly lows, daily highs, daily lows. I mean, here's my levels from today. They all have multiple confluences. Look where we're held up right now. It's the weekly low. It's an anchored VWAP. It's the value area low of the large range. It's the lower range breakout. It's yesterday's low, right? Where did I take my short off of today? This diagonal. I just waited until my entry triggers, which is we sweep up, close back down, I hit short. That's it. I don't care which one of these that happens at. Right? Generally speaking, that's all I'm waiting for, right? So which level is it? Whichever level confirms my theory that we're going to go to it, trap traders, and roll back over. That's it. I'm not like hoping or just like flying blind. I see SFP, I take SFP, right? So my entries go where the market confirms my idea. I'm coming up with my levels based off of where I think the most traders are looking. And we're going to react to it. And I usually react opposite, right? And I don't want to like screw anybody up, but because I trade SFPs, every break's an SFP. Does that make sense? Like I'm just instantly thinking, and they don't all have to, like a lot of them bounce and go and I miss it. Great. But my default mindset is it's an SFP. So that's what I'm waiting for. It doesn't happen. Great. Watch the next level. But maybe it's a break or a reaction at a key level. Maybe that's your style. Maybe your style is volume confirmation or MACD or whatever it is, you need to have the market confirm your idea. If you don't know what that is, then you're not trading. You need to have rules that confirm your idea, whatever those might be. So it's price, volume, momentum, and time, right? Are you trading during a high liquidity session? Is it New York? Is it London? We've talked about this, right? So it just goes where the market confirms your idea, just like the stop goes where it invalidates your idea. And we'll talk more about it. But break and retest, range trade, liquidity sweep, trend continuation, diagonal breaks. I think anticipation gets you chopped up, right? Which is like when you anticipate a move, it gets you chopped up, and confirmation gets you paid, right? Like I don't care. I'm just waiting for my reaction. Show me the trap traders. Show me the outside traders. This is for me. And I know, you know what? We talked about SFP plays. We are going to talk about, not today, but we are going to talk about breaks and bounces too. So we're going to get them all 3 plays. Go ahead, Brian.
Yeah. One thing that Dunki always used to always talk about, and I never really started doing until much recently, was really setting alerts.
Mm-hmm.
Setting an alert, not staring at it, right? Because if I stare, what's the quote? Anyways, but if I set an alert and I tell that alert to remind me of the plan, when that alert goes off, I'm reminded, what is the plan? Did I get the reaction that I have? And then I can take the trade. If I'm just staring at the chart, it's like I can make it do things in my mind. So yeah, that was a huge part that helped me with risk. Was setting alerts and also having the plan in the alert, right? Telling it exactly what I want it to tell me. So when that alert goes off, that alert says, go to the 3-minute, look for the SFP. If there's trap traders, take the trade. Remember the plan. And then the plan is simply to follow the plan. The hardest part about the plan is following the plan.
Yeah. So I always say, man, trading is simple. It just ain't easy because it's hard to follow the plan, that discipline. But once you start forming that discipline and building that discipline, and it all just becomes second nature. It's the shortcuts that's the longest road. It's the shortcuts that erode your discipline. Okay. So again, we'll talk more about entries. And we talked a lot about entries with the SFP video that we did, last or 2 weeks ago. So how about this? Brian, you said it earlier. The market's always doing one or two things. You're muted. Your mic's dead. So it's either
generating liquidity or seeking liquidity.
Yes.
Yeah.
Why is liquidity so important, Brian?
Liquidity is how the market moves, right? That's what moves the market. Market orders move the market. Limit orders are filled by market orders. Without liquidity, like that's what it also. When I began trading, right, I was either a market maker or a market taker. When you want to buy something, you want to buy Bitcoin, you want to buy Tesla, what do you need? You need that stock or you need that asset, and that is liquidity. So somebody has to be offering for there to be an exchange, and the most important part is that liquidity. Now, SFPs, what you love to trade, is a forced sell, right? Because it's a stop loss, right? And a stop loss is liquidity that's hidden with no set price.
Yeah. And so liquidity, very plainly put, that's where the money is, right? That's where the money is. That's where institutions and whales want to go so they can execute their orders.
Yep.
So we talked about where stops go. We talked about where entries go. Briefly, we'll talk more, but briefly speaking, where do targets go? Like, where do you target? So, okay, you know where you're wrong. You know where your entry is going to be. So where's your target?
The other end of liquidity, right?
Yep.
If there's an SFP and they took a bunch of liquidity, where do they need to unload? It's probably a point of control or the other end of the range or some other session liquidity zone. It's where they're going to be the other end of liquidity, right?
Yeah. So if you're intraday trading, what else might it be? So anything like under the
VWAP, right?
VWAPs. So liquidity lives at VWAP. If you're higher time frame trading, opposite end of the range, swing high, swing low in the opposite direction. POC, like Brian said, if you're using the fixed range tool. Yeah. If you're range trading, it's the opposite range boundary, right? If it's a break and retest, maybe it's just a prior swing or some measured move or something. If it's trend, it's the next higher high or higher low. If it's a liquidity sweep, opposite side liquidity, range VWAP, whatever, swing high, swing low. So we don't want to stretch that though. We want to be realistic, right? Because if you're stretching it and you're being unrealistic with your entries, what usually happens? You round trip a trade, right?
Yep.
You want to have take profit targets. Brian, you're really good at that because when you get those bigger swings, because you don't want to just leave money on the table, right? So have realistic targets. Remember what Brian said, it's the next liquidity pool. It's not 17 liquidity pools away, right? It's the next liquidity pool.
That's where people fail, man.
Yeah.
It's the second biggest trap is never taking profit.
Yeah.
And it's all trade specific. Like right now, I'm up 160% on an Ethereum short on 5X. And it's because I shorted the all-time high SFP.
Yep.
So I'm trading that to the other side of the range. So you have to know what trade you're in, right?
The $0.
You don't want to be in a scalp trade and have a swing take profit. That's probably not realistic because you're zoomed in and you're zoomed out at the same time. So targets are specific to your plan, and your plan is specific to your time frame. I caught that SFP 4,500, and that was it. I don't have to look at that trade for a while. Stop loss is set in profit, and I'm trading it way to the other end of the range, which is now.
So again, generally speaking, for new traders, probably target a 3-to-1. Would you guys agree with that?
Yeah.
Yeah.
And
2-to-1 might be a little.
Get out. Close the fucking
2-to-1
trade.
might not.
As long as that 3-to-1 makes sense,
right?
As far as where liquidity is, don't just say, "All right, I got my 1% stop, and now I'm just going to go 3%, or 3-to-1 into the profit." It has to make sense, right? Is there a POC there? Is there a bunch of confluence there? Or is that the other side of the range? That's what your trade should be.
Yeah. So I think here's what I'm going to show a visual example of what Brian's saying. So I think this is important. So here's what he's saying, right? So you're taking your tool, your long position tool, you want to go long here, you put your stop loss here, you measure the trade and it's only a 1-to-1 and you're like, well, maybe it could go here. You know what I mean? Maybe it could go there. No, it goes to the next liquidity pool.
Yeah.
Right. Not maybe it can go. We don't trade maybes. We don't trade based on hope. We take good trades. And if it's not this trade, guess what?
We're looking for the A+ trade, and we're cramming as much safe risk into it as we can.
Yeah, and guess what? If this isn't the trade, it's not the trade. There'll be another one.
Anything is possible, but we trade what is probable, right? Yeah. It could go to 130 grand, but the most probable thing is it's going to go to the other side of the range.
Yeah, 100%. Cool. So minimum risk 3-to-1, partial out, logical structure points. Right? Logical areas could be swing high, swing lows, depending on the side of the trade. It could be PLCs, VWAPs, whatever, right? But some people have RRs or Rs as partial outs, right? If they got 2R, they'll lock in 1R. If they got 3R, they'll lock in 2R. I don't do that. I'm just saying some people do. I just do like logical structure points. Right?
Yep.
That's it.
Put a bow on it.
What's that?
Put a bow on her.
Well, I think, let's put a bow on it. So the tactical execution checklist, and let me just share this for everyone. So here is, and again, these are all available in Discord, free 30 days, link down below, tacticaledgetraders.com/trial, free 30 days. Come and check us out. But put in the work, man. It's money ain't gonna fall in your lap, right, Brian? You can just sign up and all of a sudden you're trading.
Money might fall in your lap, but if you don't know what you're doing, you're going to give it right back.
Yeah. So here's a checklist. Before every trade, ask yourself, am I risking 1% or less? That's it. Is my stop beyond structure where invalidated, not inside noise? Did price react or confirm at a key level? So this is for entries, right? Did volume and momentum agree if you, volume and momentum, if you use those indicators? Am I entering during real session liquidity? Am I actually trading with traders, right? Am I trading New York, London overlap? Am I trading Asia? And if you're not, do moves still happen outside of those times, guys? Did we sometimes get Saturday pumps, Sunday pumps? Yeah. So, but more often than not, we don't. So if you think something's going to happen and you're going to trade, well, here, let me finish. So is my RR at least 3-1? Do I know my first and final take profit zones? If all of those boxes are checked, it's an A+ trade. If not, you wait. Or I think there might be another option if maybe one of these is missing. And then let's just pretend that's like maybe a session liquidity. Like what if you're missing one of these? Would you still take a trade if you're missing one of these? If you still felt good about it?
Yeah.
But what might you do?
Smaller trade.
Yeah.
Lower
Or
risk.
maybe scale down if one is missing and still confident, right? And that might be like come with a little bit more experience. I would say for like beginner traders, like stick to the script.
Yeah.
And once you start deviating, your data becomes bad. You start having bad data. Like, don't call audibles when you're learning is my point there. The mindset of a professional, to wrap up, capital preservation equals survival. Dunki, we are not traders. What are we?
Risk managers, man.
We're risk managers, man. Risk management equals consistency. Patience equals profit. Execution equals edge. Trading is not about predicting. It's about aligning with confirmation, managing risk, and letting the market pay you for discipline, because that's what pays the bills is discipline. That's all I got. We'll come back next. What are we doing next week? We are doing trade management next week. So we talked about, so here's what we covered so far. We talked about price structure and liquidity. Where do you enter, right? That was the first video. Second one was on time frames. Then we talked about timing, volume, and execution. Then we talked about trading traps, SLPs. Today we talked about entries, exit stops. Tomorrow's trade, or not tomorrow, next week, trade management. Then we're going to go into the break and the bounce trade, and then indicators and tools, and then the entry cheat sheet. And then we'll wrap it up with that. So that's all I got. Y'all have a good day. Be blessed.
Later.
TacticalEdgeTraders.com/trial. Get you 30 free days.